Imagine delegating your entire crypto workflow to an autonomous program. Your trades are executed, your portfolio is rebalanced, and your assets bridge across blockchains seamlessly. All of this happens in the background without you touching a single button. Warden protocol and its native token Ward are attempting to turn that exact level of automation into a reality. Look at this token's price history since its January 2026 launch. Ward quickly spiked to an all-time high of 14 cents, but within weeks, the price plummeted over 90%, crashing down to a fraction of a penny where it sits right now. So we have to ask, is a catastrophic price drop like this a clear warning sign of a dead project? Or are we looking at the ultimate ground floor entry point? To figure that out, we need to understand what Warden is actually building. Their core objective is the global agent network. It's a cross-chain infrastructure designed to let AI operate across multiple isolated blockchains at the exact same time. The group behind this, Warden Labs, carries an unusually heavy resume for a project this size. The team is built from engineers and operators who cut their teeth at Binance, Google, Uber, and even NASA. You have a team with elite institutional credentials on one side and a deeply collapsed token price on the other. That creates a highly specific asymmetric risk to reward scenario. If you want to do anything complex in Web3 right now, like bridging an asset from one chain to another while swapping tokens, you need technical knowledge, multiple wallet approvals, and patience. Warden's solution is their app. It functions as a crypto co-pilot, designed to take those complex multi-chain actions and compress them into simple chat or voice commands. You tell the agent what you want, and it executes. But handing your wallet keys over to a black box AI model carries massive security vulnerabilities. There is a very real risk of an autonomous agent making a rogue, unverified transaction and draining your funds. This chart shows Warden's solution. Agent data packets don't go straight to the blockchain. They hit a central firewall called CEX. CEX is a mandatory verification layer, a blockchain-grade lie detector using cryptography to ensure outputs are trustworthy. Once verified, it lights up green, proceeding. Because of this verified execution, AI agents can safely interact with decentralized applications scattered across multiple different chains simultaneously. Warden's technical thesis is that the entire agent economy relies on this specific layer. Without a way to cryptographically prove an agent's intent, the trust gap remains a primary bottleneck for the industry. Having strong technology is only half the equation. We have to look at the mathematical reality of the Ward token itself. Ward has a strict maximum supply of 1 billion tokens. Right now, roughly 25% of that supply, about 250 million tokens, is currently in circulation. This bar chart puts Warden's current valuation into perspective. If you look at this tiny sliver on the left, you can see Ward's total market cap sits at a microscopic $2 million. Its fully diluted valuation is exactly the same, placing it firmly in extreme microcap territory compared to typical billion-dollar infrastructure tokens. There is a potential deflationary mechanism built into the tokenomics that ties token burning to transaction fees. However, Warden has not announced a concrete scheduled burn rate yet. Despite the tiny valuation, the token maintains a solid market presence. Sentiment in their early-stage community remains cautiously bullish. You can track it on CoinGecko, and it actively trades on KuCoin, Kraken, and on-chain via Base, with MXE handling the highest trading volume. But Warden doesn't exist in a vacuum. It has to compete directly with Fetch AI, which currently stands as the dominant, well-funded elephant in the AI crypto space. The two projects take completely different approaches. Fetch AI targets broad AI services and massive agent marketplaces. Warden hyper-focuses on the specific mechanics of verifiable cross-chain infrastructure. That brings us to Warden's specific advantage in this matchup. Right now, Fetch AI does not possess an equivalent to Warden's SPEX verification layer. Investing in Ward at a $2 million valuation is an extremely high-leverage bet. You are betting that SPEX's verifiable security model will outcompete Fetch AI's broad marketplace approach over time. Zooming out from Ward's short-term bearish sentiment, we have to recognize the broader environment. The convergence of AI and crypto represents one of the strongest macro tailwinds driving the market today. Yet Ward is still trading down in the trenches, hovering right around half a cent. This candlestick chart highlights the specific technical target we need to watch for a reversal. The current price action is pushing up from below, testing this exact 1 cent resistance level. A clean break above this line would signal renewed momentum. The pros here are clear. You get genuinely innovative SPEX technology, an elite founding team, real cross-chain utility, and massive upside potential due to the tiny market cap. The cons are equally clear. The project is extremely early stage, liquidity is incredibly low, there are 0 confirmed burn mechanisms, and it faces brutal competition from established industry giants. Warden represents a high-risk, high-conviction infrastructure play, a bet specifically for those who believe the AI agent economy is inevitable. If the agent economy erupts in 2026, Warden's current valuation leaves significant room for repricing when compared to more established infrastructure protocols. As always, do your own research, size your positions carefully, and never invest more capital than you can comfortably afford to lose. This video is purely for educational purposes and is not financial advice. If this breakdown helped you see the full picture, drop a like, hit subscribe, and tell me your personal Ward price target.